tension built up in the gold price for a very long time. The circumstance continued, it got worse, it continued, it got worse, it continued, it got worse, nothing happened. And even when it moved, it didn't move because Americans were concerned about the deterioration in the purchasing price of the US dollar. It moved because the US government gave foreign central banks no choice but to save in gold away from the US dollar.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for February 23rd through March 2nd, 2026, while supplies last. This week our special is on junk silver. US 90% junk silver is $1 under spot. That's right, US mixed junk 90% silver is $1 below spot while supplies last. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. I'm always privileged to welcome back this returning guest, Rick Rule, the legendary natural resource investor, the founder of the Rule Symposium on Natural Resource Investing, and now the CEO of his own company, Rule Investment Media, formerly CEO of Sprott Asset Management, joins us this Friday, February 27th, 2026. Rick, thanks for coming back on Liberty and Finance.
Pleasure, Dunnigan. Thank you for having me on all these years. We've been friends for a long time now.
It has been a long, fruitful journey, and I remember us sitting and enjoying the weather in beautiful Carlsbad, California, in your office there, and that's when you first asked me the question, did I want to become a gold and silver dealer, and I wanted to run screaming from the room because I pictured having a room full of inventory or something like that. I have to be living in a vault or something like that, so I had some real misconceptions about what that meant, so thank you for being one of the forces that opened up that door for me and for my family. We have some viewers' questions that were submitted prior to your arrival, so we'll use those in rapid fire succession in a few minutes. But first, I wanted to give you a chance to update us on from where you sit, and you've been attending investment conferences all over, multinationally. What you're seeing right now in the metals markets themselves, as well as the bigger picture of metals physical global supply chain, really, from producer to investor and everywhere in between. But then secondly, the relationship between the metals versus the metals equities that you do focus on quite a bit, being the mining and royalty and streaming companies. So first, if you could give us your view of the physical metals markets themselves, the big picture view of that, and then we'll look at the relationship between those and the equities.
You know, Dunnigan, if you turn the clock back 15, 18 months to our conversations then, I thought 2025 would be a pretty good year. And I was wrong. It was a stunning year. It was truly a stunning year. And I think if your expectations for the future are set by the immediate past, you're going to disappoint yourself. I think we'll do well in the precious metal space for maybe as much as 10 years, but at least 5. Because I think doing well in the precious metal space, unfortunately, means that the purchasing power of the rest of our savings is going to fall. We've talked about the arithmetic of America before, so you understand what I'm thinking. What happens is that when people buy that narrative, when they buy the whole narrative around precious metals, and they get conditioned to see the response to that narrative being 100% annualized gains, if they get 10 or 12, they're disappointed, which is really stupid. If you had gotten 10 or 12% gains in 2020 or 2021, you would have been pleased as punch. So the problem in terms of understanding the market that's ahead of us isn't the market itself, but rather people's perception of it. I think we're going to have, we may have a flat year in 2026. That doesn't matter much to me, to be honest with you. I'm old enough that I don't require immediate gratification. I think the move that we saw last year is important to put in context too, Dunnigan. I think the move that we saw last year was rear-looking, not forward-looking, in the sense that everything that was true at the beginning of 2025 with regards to the deteriorating fiscal condition of Western governments, but especially the U.S. government, was true in 2017 and true in 2018. But there was no price response. People looked at the circumstance through the lens of experience that went back to 2082. In other words, people were rear-looking rather than forward-looking. And so tension built up in the gold price for a very long time. The circumstance continued, it got worse, it continued, it got worse, it continued, it got worse. Nothing happened. And even when it moved, it didn't move because Americans were concerned about the deterioration in the purchasing price of the US dollar. It moved because the US government gave foreign central banks no choice but to save in gold away from the US dollar. What that tells me is that the real natural buyer for gold mostly isn't in the trade yet. I mean, yes, the people who were clients of mine before I ostensibly retired, and the people who are listeners to you, our crew, are excited by what's happening in gold, and they believe in gold. But you live in Florida. It's like if you went to a rural Pentecostal church in Florida and asked the choir if they believe in God. You're going to get an affirmative response. But most people aren't in the gold trade yet, which tells me that gold has further to go. Now, it may be that the adherents, it may be that choir's out of breath, and there's no move in the gold price for 2026. But the whole set of circumstances that propelled gold is very much intact. So the trade is very much intact. What's important to note is the second part of your question, I think, for those of us who care about the trade, which is to say that if the gold price doesn't go up from here, or the silver price doesn't go up from here for a year, there's still room to run the stocks, because Wall Street's calculation and Bay Street's calculation on the value of these companies is predicated on $3,500 gold and $45 silver. Now, if your earnings estimates are based on $3,500 and you're selling the gold for $5,000, it's kind of hard not to get a surprise. And if you redo your net present value calculations or future cash flows at $5,000, up from 33, 34, 35, you're going to have some positive surprises. Same thing in the silver market. When I look at the Bay Street earnings forecasts and the Wall Street earnings forecasts, they're using $45 silver. If you revalue these things at, say, silver price, you get a much higher number. So I suspect, particularly with regards to the senior silver producers, that if I see a sideways movement in silver for 12 months, I see stocks that have 50% to run on a valuation basis alone. Pretty attractive. I'm not saying that's going to happen, because sometimes narrative trails arithmetic, but I'm an investor that's all about arithmetic. So I'm feeling fairly sanguine about things.
So when you mentioned in passing, and it's very interesting, you've talked to us for years about the tiny percentage of the investable net worth of retail investors that are in precious metals and precious metals related equities. There was a very interesting publication just this week from the World Gold Council, and I wanted to bring it up real quick here because it seems worth talking about in this context. Let me share this right now. Hold on. Share my screen. Here we go. See if you can see this. This is a chart of gold's investment share of global equities and bonds. So that's pretty broad category. Global, I'm not sure what that means, because usually you talk about U.S. But anyway, this talks about private investment, excluding central bank holdings, which is interesting. And then we've got this curve here that spends a lot of the last 3 decades around or below 1% of private investment share of global equities and bonds for gold. And yet it shows just now in the last year, and partly this is a natural factor of the prices rising nominally, as you would say, because even if no action was taken on the part of the participants, the very fact that the nominal price is rising of gold and silver would mean that that's going to likely fight for a higher percentage of portfolio allocations. But it's showing us just ready or breaking through 2%. Is that different from the specific one that you've referred to about this 0.5%?
In many ways. First of all, and most importantly, this is global. At a point in time when I described gold as comprising 0.5% of Americans' holdings, it comprised 1% or twice as much of foreign holdings. What's happened since is that mostly foreign currencies have declined relative to the dollar. So the gold price has gone up in dollar terms, and the dollar has gone up in rupiah and renminbi and yen and euro terms. So the gold has revalued in the foreigners' accounts, and they already had a higher percentage, a higher market share in gold than we did. And this chart demonstrates it. Gold continues to be substantially underowned. What's interesting about this chart is where you would call reversion to mean. If you look at 1980, when gold was in favor, gold had an 8% market share. What I'm interested in is even if gold didn't come close to capturing its former market share, if there was a reversion to the 40-year mean, my suspicion is that gold demand would be substantially higher than it is today, too. Note something else. The market share of central banks' holdings of gold had fallen substantially. So there's competition for gold in the market now. To the extent that the retail buyer, the private buyer, comes into the gold market, there is still substantial central bank buying. So there's two classifications of buyer now. All of that's bullish. Investor behavior, however, which is sort of what that chart is about, isn't as important to me because in the near term it's shaped by narrative than investor motivation. Investor motivation, I think, will be shaped by the deterioration of purchasing power in fiat currency denominated instruments. I think that's really important. In other words, the narrative will follow the incentive. And the incentives, debt and deficits, quantitative easing, unfunded entitlement promises, the slow realization that people have that their savings and salaries are not keeping pace with the deterioration of the US dollar and that they need to change their savings matrix to protect their capital. I laugh. It's tragic for most people. But that's going to have dramatic impact. You know, when I say, I need to be better about how I communicate this. When I say in the abstract that I believe the purchasing power of the US dollar declines by 75%, people nod sagely and then, go on about their day. What I need to say is that a pensioner who is living today on $4,000 a month will require $16,000 a month to maintain the same standard of living 10 years from now. And where will that extra $12,000 come from? When people personalize it like that, when people understand that if they're getting paid 4% on their savings, in a currency where the purchasing power is declining by 4% a year, what's happening is they're losing half their savings rather than making 4%. People need to personalize this. Whether or not they buy gold is of less interest to me, frankly, than whether they understand that they are responsible for their future and their children's future. Their community isn't, their government isn't.
Getting back to what you were saying recently and then way back in the beginning about those who are in the choir maybe cheering, seeing the nominal prices increase of the metals, but what that usually indicates is hard times, one form or another. I want to share another snippet out of that same World Gold Council report. Here's a chart that shows about 10 different times of stress in the past several decades and how equities, U.S. stocks in particular, in green bar, versus U.S. treasuries, the blue bar, versus gold have performed during those times of stress. They show the dot-com bubble bursting. They show 9/11 happening. They show the 2002 recession, the Great Recession, which is, that's 2007 through 2009 and 10. Sovereign debt crisis 1 and 2, Brexit, 2018 pullback, COVID, lockdowns, and so on. 2022 pullback and tariff uncertainties. In all of those examples, they show significant negative bars punching downward below zero for performance of U.S. stocks. rather comparatively anemic protective benefits of U.S. Treasuries, or even losses in Treasuries in 2022 versus the performance of gold. There's only one example. I guess the dot-com bubble is the only one where gold didn't outperform both of those other measures. Any comments from you on that phenomenon of gold being a safe haven asset during times of trouble?
Well, interestingly, what I have found in my own experience is that gold's response to news is of short duration. What people are really concerned about, this is the maintenance of their purchasing power. It makes sense of sovereign debt crisis that people didn't want to own foreign bonds. But you'll note that in sovereign debt crises, U.S. Treasuries did very well. What changes now is that U.S. Treasuries, I think long-term U.S. Treasuries, I think their future performance was defined by Franz Pick, when he described them as certificates of guaranteed confiscation. If you buy a 30-year bond yielding 5.2, and your purchasing power is declining by 8 to 10% compounded, when the market begins to realize that there's a negative real interest rate, the capital value of the bond declines at the same time that the purchasing power of the yield and the stored principal declines. And that changes that graph really substantially. Really substantially. Imagine for a second that rather than being a gold dealer and a podcast host, that you were running the University of Florida endowment and you were responsible for investing the endowment of the University of Florida for the benefit of the institution and hopefully its students 30 years from now. And don't say quit. Don't say I quit. Imagine that you inherited a portfolio that was 65% long bonds because they were riskless. And imagine that you suddenly woke up at 2 o'clock in the morning and said, wait a minute. In 30 years, the purchasing power represented by the principal in that bond has declined by 80%. Dunnigan now has to do something. And I think that's the realization that people are coming to. Their fondness for long-dated treasuries is a relic of the period 1982 to 2022, where the U.S. dollar was strong, where real and nominal interest rates were falling. And in 2022, and you saw that on that chart, the world changed. And it changed in a way that changes the composition of asset responses to crises. I would argue in favor of gold. The only thing that would change my mind would be a real default, which is to say a deflationary circumstance. And I, in my lifetime, have watched the fiscal response to deflationary pressures as always having been printing.
Well, you as much as anyone I know is painfully aware of the proclivity of those stewards of endowments and insurance executives and those to be conservative in general, to try to follow tried and true guidelines. And unfortunately, for the past 2 years, you've been trying to help us, together with Alistair and Andy, to address some of these audiences and explain what you just explained about the necessity of them looking at a new playbook rather than the one that's been used for the past 40 years. And yet, distressingly for me, primarily for the good of those people for whom they are the shepherds of the future continuity of business operations or continuity of their financial lives, of their people that are counting on them, is that they're turning a blind eye in many cases. Now, we have seen some pronouncements in the last 6 months from rather on high investment directors of this or that fund or bank or whatever saying, you really should have 20% gold in your portfolio or 25% or whatever, rather than just punts. How materially impactful do you believe that those new admissions are from sort of on high to the actual practice of those who are shepherding funds on behalf of all of those endowments that we just talked about?
It's changing. I mean, the people who run these endowments, like every other investor, have had their opinion of the immediate future shaped by their experience in the immediate past. And their experience in the immediate past has been, thou shalt not rock the boat. We saw this. I was too young to understand it, but I understand it now historically. We saw this in the period 1968 to 1982. There were 5 years when the writing was on the wall for the U.S. dollar and the U.S. Budget. We fought the war in Vietnam, which we lost. We fought the war in poverty, which we lost. We had the bills left over. Circumstance very much like today. And price levels in the United States were running substantially higher than government estimates of inflation. And they were running substantially higher than the then controlled interest rates. And nobody cared much. I mean, yes, they had little buttons that said whip inflation now. I don't know if you remember Gerald Ford. All those morons. But nobody was really paying attention until they did. And when they did, beginning in 1972, they began to worry in earnest. Now, in 1975, Congress actually took action. They raised the interest rate. And when they raised the interest rate precipitously. When they did that, they cut the price of gold in half in 9 months. They also obliterated the U.S. long bond market, obliterated the equity market, and kicked the housing market in the cojones. And in 9 months, they lost their courage. They cut the interest rate again, printed, and what Congress did is they announced to the world that their reelection was more important than the sanctity of the U.S. dollar. And that time, the world had 5 years preparation, and gold went on a real romp. Gold went from $100 at the end of 1975 to $850 by the end of 1981. It was a hell of a romp. I think past is probably prologue. I think over time, the portfolio managers get ambushed by reality, much as they did in 1972 and 1973. And then I think you're going to see a fairly dramatic response.
We wanted to move on to the next topic related to this, and that is, we've talked about the gold market and valuation and the dollar valuation. What about the response of the equities, the mining companies, exploration companies, royalty and streaming companies, to movements and outlook for the metals?
Well, I believe, just because I read the analyst reports, that the analyst reports, both in terms of their earnings forecasts and the net present value calculations, are predicated on sharply lower precious metals prices. If the precious metals prices trade sideways for a year, it would suggest that valuations can move higher. The consensus metals prices on Wall Street and Bay Street around gold seem to cluster in the $3,200 to $3,500 an ounce range. Now, it seems to me if you make the stuff if you sell the stuff for $5,000 and your earnings forecast is based on $3,500, that arithmetically you're pretty likely to surprise folks, and the surprise is likely to be good. Similarly, if you're doing a net asset value calculation of future cash flows and discounting them back at Wall Street's prevailing 5% discount rate, and you're using a $3,500 denominator, which is to say a $3,500 gold price in a $5,000 world, that you are understating the value of that company fairly substantially. If the gold price doesn't fall fairly substantially, it would seem to me that the good guys, the real producers, revalue very, very substantially just to reflect the current reality of this gold and silver price, not to anticipate higher prices. I was fairly public a few weeks ago about selling 80% of my physical silver. I did it for two reasons. I did it because silver occupied a speculative position in my portfolio. Gold for me is a savings asset. Silver was a speculation. I bought silver because it was hated. You'll recall, Dunnigan, in our earlier interviews, when I described silver as a coiled spring, that when the hate dissipated, it would be easy for the price to double. Well, it didn't double. It went up fivefold, sixfold. When that happened, the reason that I owned my silver went away. I owned it as a speculation. And I had to decide, was it still the best speculation in my portfolio relative to the amount of capital I had tied up, or was there something better to do with it? And I decided for half the money that was in my silver portfolio that I'd rather buy the silver stocks. Because if silver didn't go up anymore, by definition, I couldn't make any money. If silver did go up, the silver stocks would go up too. But if silver just went sideways, the silver stocks would go up by 50%. That seemed like a better speculation to me. For me, it's all about arithmetic. Ironically, if the price of silver fell, while the price of the silver stocks would fall, the values wouldn't need to fall very much because the net present value assumptions were made at a $45 silver price. So if the price of silver fell from 80 to 50, that's still above the consensus silver price that people have used to calculate those net present values. So it seemed to me like I had a better speculation in the silver stocks than the silver. Now, for me, gold is a very different circumstance. I save in gold. So 25% of the capital that I drew out of the sale of 80% of my physical silver went into physical gold. Because I wanted to take some of my speculative gains all the way off the table and get them out of harm's way. And as you know, Dunnigan, since the year 2000, I've maintained liquidity in US dollars, but I've saved in gold. I regard them personally for myself as very different assets or asset classes. I don't know how your customers feel about it, but that's how I feel about it.
We have a lot of other questions that were submitted for you around these topics, so we might as well just plunge on in there. One of the things is from Yukon Cornelius OG says, Rick, it's been widely reported that you've sold your physical silver to buy miners. Can you clarify whether this was physical bullion or PSLV shares? Thank you.
That's a good question. I sold my PSLV because it was so easy. I don't have to call Dunnigan. Dunnigan doesn't have to find a bid. I don't need to take it out of a vault. I can sell my PSLV with a click of a mouse. I still have my physical silver, partially because I'm lazy.
Well, okay, this is a related question to that last one. We'll get back to the main thread in a moment. But Bill M. from Florida says, Rick, to use physical gold and silver as collateral for borrowing, are you concerned that tokenized gold could be so much easier, cost-effective, and safer on a blockchain ledger than to do with your bank arrangement with Brinks? Peter Schiff appears to think so.
2 years from now, when real tokenized gold and silver appears, when they are delivery receipts that are housed in institutions like Brinks that are publicly traded or in the Royal Canadian Mint, my belief is that the technology will exist so that Battle Bank can charge against gold tokens. Right now, the only form of security that I feel comfortable with my customers having in their own accounts are not tokenized metal, but rather metal itself. With the technology that exists today and the regulatory climate that we have today, even the tether instrument, which is fairly liquid, doesn't work for me. I want my repository to be surrounded by a body of precedent and a body of law that I know my rights. And I don't want my security housed in a wallet that could be hacked. So given the current state of technology, I want my collateral. Listen, I own gold and silver, gold in particular, because I want to worry less, not worry more. And the idea that I would superimpose another level of worry is not something I'm interested in. I believe 2 years from now, 2.5 years from now, the technology exists today, but I believe the regulatory protocols will exist that will have a coin that is a securitized depository receipt housed in a depository institution that I can trust. Even Tether, I know these guys. I have a high degree of regard for them. They house their gold and silver in a private vault in Switzerland. They don't share the audit results with me. The vault isn't in a publicly traded company. I don't think publicly traded companies are superior, but in a publicly traded company, I can see the income statement and the balance sheet on a quarterly basis. In other words, I know that my vault will continue to be in business and that the steward of my gold and silver won't be a bankruptcy court somewhere. I'm very picky. I'm very picky about how I store my savings, and I'm very picky about my collateral. And right now, my collateral has to be physical metal with an established precedent, an established body of law, and it has to be in a facility where I know, if not love and trust, the fiduciary. If the owner of a private vault lies to me, I can sue that person. I can prosecute him for fraud. If Brinks lies to the SEC in a filing statement, that's a felony. It's not Rick Rule's beef. It's Brinks v. the SEC. And that's important to me. I do not own gold to increase my risk.
Very interesting points you're bringing out there about established bodies of law that clarify all the guardrails around certain business practices. And when you're on the leading edge, or some call it the bleeding edge of progress, that can lead to ambiguities or changes and potentially technical vulnerabilities. Now, you mentioned, maybe 2 or 3 years from now, we'll have more definition around the law part, but this what would you call it? Leapfrogging of Cold War, of technology versus technology, spy versus spy on making sure that things are hack proof, and that, but as soon as they say, as soon as quantum computing is out, then they can be hacked, Bitcoin can be hacked, and blah, blah, blah. There won't be any cyber protection from that. So I think you've already probably addressed the follow-on question from the same questioner. How is physical gold held in a Brinks vault any safer than owning tokenized gold issued by an equally reputable source? And I think you've dealt with that one.
Way, way, way safer right now. There's a second thing too that probably interests you, Dunnigan, which is to say that there's a lot of physical gold holders who won't make the switch because of capital gains tax. Think about an old, fat, cranky, bald guy like maybe Rick Rule, who began buying gold in the year 2000, whose basis is a little less than it is today. It is not in my interest to liquidate gold, pay a substantial capital gains tax, and use the proceeds to buy gold tokens. They are not the same asset class, even if they had the same body of law around them, because my ascribed value would be reduced fairly substantially as a consequence of tax. We have learned that there is, by we, I mean Battle Bank has learned that at current gold prices, there is at least $50 billion of bullion holdings held by U.S. people in storage in types that we recognize. And a substantial amount of that is going to be frozen in physical metals as a consequence of, depending on how you hold it, collectibles tax, or at best a capital gains tax. And that's an important consideration.
That's interesting consideration for a lot of our viewers and subscribers who have also been accumulating physical metals. They're now asking lots of good head scratching questions about, as we've been cheering for the increasing price of gold, and now they're contemplating the potential tax consequences of acting on utilizing any of that increased value. We have a question. Felix the Cat 69 says, this is a tough one. Rick said about a year ago that Battle Bank would provide loans on metals for around 5%. I would like that deal, but how would I get 1.5 million in metals to the nearest Brinks facility with the least amount of friction? I guess I'll answer that for anyone who has the same problem to solve that Felix is talking about, that I can help with that. My team can. They can certainly reach us. You guys know how to reach us. Please feel free. But any tips just from your perspective, Rick, on people who don't?
Well, first of all, I don't know where we got the 5% number from. We would loan money very much like a margin account, 50% loan to value. And it's a floating rate, prime referenced rate. It is not 5%. It becomes negotiable on very large loans. In terms of moving the precious metals to Brinks, that's easy to do. But I would suggest that we have credit agreements with many of the best dealers in the country, including Miles Franklin. And the dealers have long experience moving gold. If you're dealing with a dealer that has less experience, we will cooperate with the dealer. Believe me, there's nothing in the world that Brinks wants quite as much as your gold in their storage. And they are very, very, very good at facilitating that transfer. It's in their interest.
If you haven't, folks, you really should see the movie that came out about 5 years ago, Elvis. There's one place in there where the owners of the international hotel or whatever he was on the stage of said, as long as that boy stays on that stage, you got an infinite credit reporting or credit line, he said to his manager. So yeah, they want that boy to stay on that stage. Rick, here's a question related to the financial environment we find ourselves in that you said, be careful what you cheer for because gold goes up as a warning indicator in times of other financial stresses. Bart Caldwell, KC6 says, as home mortgages are now being paid off with cheaper and cheaper dollars and inflation heats up, is there a reasonable chance or risk that mortgage companies will try to increase the nominal balances due to offset inflation?
Well, that's governed by contract. If you have signed a variable rate mortgage, I would say switch it to a fixed. Let's get that done. Variable rate mortgages are usually tied to various indexes, and to the extent that the credit markets become more expensive, your mortgage becomes more expensive. Traditionally, people who own long-term fixed rate mortgages during periods of inflation do extremely well. I don't have a home mortgage, although if I was financially rational, I would. My wife regards our dwelling as a home as opposed to a house, as a financial asset. But were it otherwise, I would try to have a circumstance where, particularly with rental real estate, where my cost of capital was fixed and my return on capital employed increased a little bit. I don't think that in the United States, even with the idiotic interpretation of the rule of law that we have today, that a mortgage company could unilaterally change your mortgage contract and change a fixed rate obligation to a floating rate obligation. If they tried that, and were I litigator, I would love that case. But I don't think that's your chief worry. If, however, you have a short-term mortgage, or if you have a variable rate mortgage or a reset mortgage, you need to be very concerned, because it isn't the mortgage company that's going to take your rate up. It's going to be the credit markets.
We have a question here about managing risk, again, relating to banking. Fish with No Eyes says, Rick, you often speak of managing risk. Your new Battle Bank is said to offer upper quartile interest rates on savings accounts. How is your bank going to be safer if beating the market in returns?
Thank you for that question. First of all, our bank is, in a sense, an old-fashioned bank. Our regulators suggest that a well-capital bank has equity at 7% of total assets, which is to say employs 90% plus leverage. Your bank, Battle Bank, is run by two old guys, and we think 10 is a better number than 7, which is to say we will be, by conventional standards, under-leveraged. The second thing is that interest rates or deposit interest rates are just one of the costs that banks face. A different cost is facilities. Battle Bank is branchless. Our competitors lose, on average, 150 basis points of their credit spread by having a branch system. We don't have a branch system. There are some depositors for whom not having a branch system means that we won't get their business. We will only be able to attract people for whom this is our branch. I realize that dumb people need a bank, but they don't need Battle Bank. The consequence of that is that while the interest that we pay is higher, our operating expenses will be lower. The third thing is that we will not, as lenders, try to do all things for all people. Some of our banking competitors have come to believe that they're competent in 1,000 industries. And once every 10 years, they prove just how wrong that is. There are certain things that Battle Bank has done, or the people behind Battle Bank have done for a very long time. Certain industries we understand. Oil and gas, publishing, precious metals. we will limit ourselves to asset classes where we understand the value of the collateral. And then the fourth variable, which is customer acquisition costs. Most banks spend a fortune, I'll just say it, lying to you. They spend a fortune on advertising. They spend a fortune on devious deposit products. At Battle Bank, we have developed a waiting list of 22,000 people who want to do business with us. They want to do business with us enough that they've told us, after having reviewed the menu of goods and services that we offer, which of the services that they'd like to access. And this has occurred at effectively zero cost to us, with the exception of wear and tear on my carcass. So if you look at the fact that we pay higher interest rates, that's offset by the fact that we have lower facilities cost, zero customer acquisition cost, that we don't engage in time spreads. In other words, we don't make long-term fixed rate loans that we fund in the overnight. In other words, we're not going to go the way of Silicon Valley Bank. It does something else too. And this is really important, Dunnigan. I'm glad this question was asked. At Frank's prior bank, Everbank, they really pioneered honest banking. Rather than having 15 deposit products designed to hoodwink the customer, many of which paid no interest, they had one simple cash account. You could write checks on it, and it paid good interest. They also enabled savers to save money in 28 currencies rather than just one. And what happened, and this is subtle but important, what happened was that the relationship between the bank and their depositors was ecstatic, as opposed to mutinous at most banks. And when the refinancing boom of the early part of the decade of the year 2000 to 2010 happened, Everbank became one of the largest mortgage originators in the U.S. without having to advertise, because their depositors had a relationship with the bank and said, "Will you give us the mortgage?" And my hope, my belief, is that by treating our depositors fairly, we'll get some of the rest of their banking business without having to compete with other banks for them. In other words, I believe that the fact that we, as an example, pay interest on savings where our competitors don't, is in effect an advertising expense, in addition to being the right thing to do.
Thank you for that. And I think our questioner would appreciate all the detail you offered there. I forgot to ask you one important question back when we were talking about the global precious metals markets. This is important, and you can take this wherever you want. The two questions, I'm going to ask them both. They're from two separate questioners. One is from Douglas Desmond, 8372. How is India and China breaking away from the U.S. metal markets going to affect our markets? Related one is TACman 556 says, is the price variation on spot between New York and Shanghai a result of China being buyers and U.S. being sellers?
The answer to the second question is, I don't know. So let's get out. The answer to the first question is probably, I don't know too. I suspect over time that metals are fungible, which is to say, if one market finds a way to have a real plurality over another market, that the metal will chase the money. I'm reminded years ago when the Indian government put a big excise tax on physical gold and silver. And I talked to some Indian friends of mine who are, well, I would call them traders. The Indian government would call them smugglers, about the impact of the excise tax. And they said, well, we hope they increase it. And I said, well, how does that work? They said, well, it costs us 2.5% to get gold from Dubai to India, and we sell it without the tax. The government has basically built in a 12.5% margin for us. That tells us that over time, disparities in markets are solved by informal means. Not in the near term, but in the longer term. I would note, too, that the recently publicized pronouncement by the Chinese government that they were going to limit the exports of silver to their licensees was less about limiting silver and much more about rewarding their friends. They immediately awarded 42 export quotas to people who I suggest were probably fairly close to the regime. It's important that you understand their news in context.
Now, in the context of reducing risk and looking at asset values. We've talked about being able to use Battle Bank for taking out equity loans against precious metals. Here's a related question from Just Told Joe 9328. Rick has stated that he prefers gold to hold his savings, but does he see any other physical assets such as farmland to be options as well?
I own, relative to most people, a fair bit of farmland. I don't stretch fences or plow. I own farmland, which I lease to people who are good at it, who like it. And I consider it to be a superb asset class. I myself have always owned land with attendant water rights because I think water is a misplaced asset. And I think controlling the water enhances the value of the farmland. And I've been able to prove that, by the way, in the rents I charge. So yes, I consider high quality farmland with attendant water rights to be a very good long-term investment. I have similarly had very, very, very good luck with timberland, understanding that to realize the value in timberland, you must be prepared to hold it for a very long time, which I have been. In the case of both my farmland portfolio and my timberland portfolio, I suspect that the sell decision will be made by my heirs. In other words, it won't occur in my lifetime.
A pair of related questions here, and then we can move on. Nitro Burp 2694 says, no one seems to talk about GATA anymore, the Gold Antitrust Action Committee. They were going after the CME and the COMEX. When will we see justice? And then Buck 40 Pool Genius says, if the COMEX ever does really fail, does it really make a difference? Or does the COMEX ever really fail? And if so, does it make a difference?
The COMEX doesn't fail. Listen, the GATA guys are good friends of mine. I enjoy them. I enjoy the fact that they enjoy debate, often with me. I don't believe that markets have been artificially suppressed in the long term. Markets are manipulated all the time. Markets as big as the Treasury market are manipulated. Traders manipulate markets. That's what they do. This spoofing that you've seen will never quit, ever. But the idea that there was a 40-year-long conspiracy to depress the price of gold while the U.S. dollar was strong flies in the face of arithmetic. It's convenient for people who made the wrong bet psychologically, but it's silly. GATA has been reduced in importance in terms of the public debate around the gold bugs because the gold price has gone up. You don't need to blame anybody. I mean, the gold price as recently as the year 2000 was at $256 an ounce. Now it's at $5,000. Some suppression. Now, as to COMEX, this fantasy that the sort of Reddit crowd had that they were going to teach J.P. Morgan Chase a lesson by squeezing physical supplies suggests that these people don't know very much about the law. The exchange is owned by the exchange members. You saw imbalances in the tin market. What did the exchange do? They declared force majeure and they cash settled.
And nickel, they rolled back trades. Yeah.
Correct. The idea that you're going to catch J.P. Morgan or Loeb or Conti or Cargill or any of these guys short is nil. You might face them into an ugly cash settlement, but the idea that they would have to go to the market and buy physical silver at any fiat price, that isn't the way it works. You know, I forget who it was, but they said there's a club and you ain't in it. So please understand that.
We want to turn our last segment here onto your offers, and those are several. Generally, you're doing educational offerings on a continuing basis. I understand always in July, you've got your upcoming flagship conference, the Rural Symposium on Natural Resource Investing in Boca Raton, Florida. Folks, there's a link in the description of this video. If you want to use that link to register for the conference, Rick will tell you why you'll be your benefit if you go to that, and you'll be helping our channel if you use the link in the description of this video. But why should people consider the flagship conference in July? And then we're going to talk about something you've got even sooner than that.
I think, Dunnigan, that ours is unhumbly the finest natural resource investment conference on the planet. We've been doing it for about 30 years. I don't know exactly how many years, to be honest with you, but I'm told about 30 years. And if you make something a little better every year for 30 years, by the end of it, it gets to be pretty good. And we think it's pretty good. Why is it good? What's our promise? Well, first of all, we have for years assembled great big picture thinkers. That people who have told you about the way the world is, as opposed to the way that CNBC or Fox would have you believe it was. And we've done a really sterling job over 30 years explaining the world in ways that people don't have it explained to them on the nightly news or in the morning papers. And that's valuable. After we do that, we try to help you actualize that information in real time in real ways. We have analysts, natural resource and precious metals analysts, who are not Johnny-come-latelys. People who have been active in the space for 40 years. At many conferences, you have analysts whose track record is precisely 18 months old. In other words, they've only been around for the bull markets. They haven't been around for the bear markets. And believe me, that can cost you a lot of money. We have investors, which are different than analysts. The John Hathaways of the world, the Adrian Days of the world, who have been active in precious metals markets, again, for 40 years. And they tell you the mistakes they've made. They tell you the techniques that they employ. They tell you how to best optimize your own money based on their own 40 years of experience. More importantly than that, every exhibitor at the conference, if they're public companies, has to be owned in the sponsor's accounts. At every other conference in the world that I know of, the qualification to be an exhibitor is a check that cashes, which is not a very onerous test. It doesn't mean that every stock I goes up, my own goes up. It does mean that I've vetted every single exhibitor personally. Any bullion dealer at my conference, including Miles Franklin, has to pass a pretty tough test. I have had no customer complaints about that firm during my duration in the business. A customer complaint disqualifies a bullion dealer. It doesn't mean that you don't need to employ your own caution dealing with the bullion dealers, the coin dealers, or the public companies. What it does mean is that unlike any other conference on the planet, they're vetted. Also, unlike any other conference on the planet, I interview every exhibitor and every speaker on YouTube before the conference. So you come to the conference prepared to allocate your time and capital much more efficiently. At every other conference, it's limited to the 2 or 3 or 4 days of the conference. Our conference goes on for 12 months. 12 months because every one of the proceedings is recorded. In the 4 days at the conference, we give you 46 hours of programming, which, believe me, is more than you can accommodate. What that means is to get your money's worth out of the conference, in addition to attending the conference, you have to play the tapes. We make the conference available either live, which I would prefer, or live stream, which is more convenient. That's important too. And more important than that is that however you attend, live or live stream, A, you have access to the recordings, which you'll need, and B, it comes with an unconditional money-back guarantee. If you think for any reason that we didn't deliver you value for money, email us, no questions asked, you get your money back. There's no other conference in the world that I know of that has a money-back guarantee. Now, I'm delighted to say, I think, last year, in terms of physical attendees, we had no request for refunds. And out of 1,400 live stream attendees, we had 3 requests for refunds, which suggests that the people who didn't think that we delivered were well less than 1/10 of 1%. Special note this year, if you would like to attend in person, for the first time in 20 years, we are going to sell the conference out. Well, we sold the room blocks out now, which means absent some cancellations, you'll have to stay next door. But this conference live will sell out within 3 or 4 weeks. Our live stream admission, where you attend the conference via your computer in your own home, we have unlimited attendance at. So it's much less timely if you would expect to attend virtually than in person.
I've been there in person the last 4 years in a row, and can attest to the facilities and the quality of the value of the information shared there. Those of our viewers and subscribers who use the link, as there is now in the description of this video, to go there have told me the same, that they valued their trip. Some have come as far as from Puerto Rico, from Alaska, from other places. It's been a great thing for many to find out about those needles in a haystack that you have, through your hard labors over the wee hours of the night and all the times that you've been poring over balance sheets and talking to management teams and so on, have elevated up to where they're on the surface. The cream of the crop is right there, ready for people to learn about. And we'll be providing remote interviews from our studio of many of the presenters at the conference, before the conference and in coordination with the conference, to help augment that, so people are more aware of that. So folks, look in the description of this video. You'll see a link on how to get your tickets for the Rural Symposium on Natural Resource Investing. Now, in addition to that, Rick, you've got boot camps that come up that are a less of a time-intensive commitment on people's parts about very high interest and high value topics in the space. What's your next boot camp?
The next boot camp, April, I forget the date, is about copper. Copper is very timely. We've underinvested in copper for 30 years. Meanwhile, global economic growth and the rise in technology, as an example, data centers and electric vehicles, but also the increasing living standards of poor people around the world, guarantee, I believe, that we'll be facing a production shortage in copper that will only be rectified by price. An extremely, extremely, extremely bright outcome that I think can only go one way. There's lots of ways to make a bad copper investment, however. We will give you 8 hours about copper, all about copper. We'll teach you about the copper markets. We'll teach you the fundamentals of copper geology. We'll teach you how to analyze senior copper stocks and copper exploration stocks. 8 very hard hours online. If you're the type of person who buys the Sunday paper for the crossword puzzles, don't come. If you're the type of person who understands that they need to understand the subject before they allocate capital to it, absolutely do come. You will again have access to the recordings. You will again need them. We're going to give you more information in 8 hours than you can possibly absorb. It comes, like any other educational product that I offer up, with an unconditional money-back guarantee. If you think for any reason that I didn't give you your $99 worth, I'll give you your $99 back. Just come prepared to work.
So folks, we're also going to put a link to register for the boot camp on copper investing in the description of this video. And again, if you use either the Copper Bootcamp link or the Rule flagship, the Symposium on Natural Resource Investing in Boca Raton link, you'll be helping out Liberty and Finance as well, and we appreciate that. And it's been a win-win-win for everybody involved. Participants have uniformly thanked us for having provided that opportunity to get and in fact, that's throughout the year, Rick. Whenever anybody calls me and asks me, they say, Donegan, you talk to all the people all over. You know what's going on. What company should I get invested in? I go, well, I can't tell you, but I know a guy who knows the best and the brightest. And if you want to know what he's thinking, go look at his website for his next symposium and you'll get a clue on who he thinks are the best and brightest. So thanks for making that available to all of our viewers and subscribers. And any parting thoughts or shots that you have before we wrap?
2. Anybody who wants can go to my website, Rural Investment Media, and I personally will rank their natural resource stocks for free. Go to Rural Investment Media, list your natural resource stocks, please no pot stocks, please no crypto, please no tech stocks, and I'll rank them for free. And I'll comment on individual issues if I think my comments might have value. Finally, I'd like to thank you, Donegan, and the Kaiser family for your participation in these interviews and in our conferences for a very long time. I've enjoyed our conversations. I hope they benefited your customers. I hope they've benefited you. They've certainly benefited me.
Absolutely true. And also, if people want to not only have their positions ranked, but also get more information or get on your waiting list for BattleBank?
BattleBank.com. We are now, after almost 5 years of trying, we're open for business. We're actually making gold loans. We're accepting deposits. When we first opened up, we decided to test the systems on friendlies like me. We wanted to make sure that checks cashed, deposits deposited, wires wired. We've done that now. And so we're opening the bank on a selective basis to shareholders and people on the wait list. If you'd like to bank, let's just say if you're interested in interest, if you want to get paid interest on your checking account, if you think that you might want to save in some currency outside the US dollar, if you'd like to borrow against your gold, silver, platinum, or palladium, go to battlebank.com. Have a look at the menu of the products and services we offer. Sign up. Let us know how we can serve you.
Well, Rick, thank you for joining us on behalf of all of our viewers and subscribers for being here with us again on Liberty and Finance.
Pleasure. Look forward to seeing you.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for February 23rd through March 2nd, 2026, while supplies last. This week our special is on junk silver. US 90% junk silver is $1 under spot. That's right, US mixed junk 90% silver is $1 below spot while supplies last. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.